Let me introduce our speaker today. His name is Alex Siu. Alex is the first chairman of Malaysia chapter of CMT Association. He has extensive experience in the fund management, and formerly he served as a fund manager in VCB Capital, a boutique asset management company for more than 5 years. And currently, Alex is the fund director of SC licensed robo-advisory firm, which is the BH Global FinTech Solutions. So he specializes in trading systems and strategies, value investing, trading psychology, as well as designing, developing, and programming of machine learning algorithm for robo-advisory. So without further ado, let me pass the presentation to Alex and enjoy your learning.
Okay, thank you. So let me be able to share. Okay, thank you. Right. Okay, hope everyone can see. All right. Welcome. Good evening, everyone. Yeah. This is my second time sharing for Bursa sessions. Right. I'm still quite new here. I've been sharing for CP sessions for SC for I think over 7 years now. So this topic, FCPO, is definitely not the topic that I would say I'm a specialist in, because I do know many specialists in FCPO who are doing really well. Okay, so but what I can contribute, I think, in this MCO time, the most important is we support each other, yeah, and we have fun learning while we are under MCO, and we keep on the spirit up and also explore maybe new learnings. All right, so we don't have to be limited by the distance that we can travel, but rather our mind can travel globally and also to learn new things, and we can help each other to go through this tough time together. I think that is very important, because humans are social animal, and one way we can spend so-called virtually social is that we can learn things together. Okay, all right, so I hope everyone is doing well. How many of you have attended my topics or talk before? Can you put a 1 on the chat? If you have not, put a 2, please. Thank you. Okay, because I just want to see, have you all attended my topic before? You know my style and how detailed or depth that I can go into. Yeah, so I see a lot of tools there. So it's your first time with me, and normally the feedback is that I talk too deep, I talk too fast, and catch no ball. Okay, these are the common feedbacks lah. Yeah, in the CP sessions. So the previous session for the first time I speak for Bursa is on the machine learning for FKLI. So that topic, the feedback is a bit too deep. So it's okay if you don't really understand, but I just hope you keep an open mind, because learning is fun, yeah, and trading is fun. So even though you don't really catch 100% of what I say, it does not matter. And there are also many other topics and classes that you can go through, all right, and have fun learning. So if you don't understand and you're really, really keen on what I was saying, you can always type in the chat box there, and I will answer you during the break times. Okay, all right. So let me just give you a big picture of why am I sharing this today. The answer is because, well, you all can see that I came from a technical analysis background. CMT is very much technical analysis, and 20 years in technical, I would say that there is a time where you feel that definitely there is more to it than lines and graph and charts. Yeah, so it's true enough. Fundamental and technical are not the only two ways to analyze the markets. No matter which market you are looking at, you can be looking at commodities like FCPO, soybean, gold, silver, or you can be looking at indexes, okay, like FKLI, Nasdaq index, S&P index, okay, all the global indices, Hang Seng, Nikkei, okay, and you could be also looking at stocks. There's definitely not just two ways of looking at things. In fact, to my knowledge, there are 4 ways. Okay, so other than fundamental and technical, there are also quantitative, okay, and there is also sentimental. Sentimental means that you can measure and quantify the sentiment of the market, maybe through news. So it's talking about computer able to read news through MRN, machine readable news, and you can also have a robot that can detect the tones of, let's say, Jay Powell speaking. Is he nervous? Is he confident? That sort of things. That's sentimental analysis. Measuring market sentiment and convert it into technical indicators. That's very fun. And I have other topics on that. Okay, not this topic. Right, but today I'm going to talk about quantitative, which is also very fun and is slightly different from technical analysis in the sense is that it's more of a science than an art, whereas technical analysis is more of an art than a science. So there's always been a debate and a question to me, what's the difference between quantitative and technical? And my very simple answer is when it comes to technical analysis, the same chart, if you ask 100 people, they can give you 100 different answers. So to me, that is art. And if you have an experiment, like a school science experiment, that when you repeat the experiments, it comes to the same conclusion, then 100 people repeat that experiment and can come to a very similar conclusion. And then that is a science. And that to me is quantitative analysis. So the difference between quantitative and technical is technical is more of an art, quantitative is more of science because it's repeatable and it has steps that can have some mathematics background to back up the theory. Okay, so that's the background, the big picture behind what I'm sharing today. So my encouragement to everyone is that if you are bored, okay, with fundamental, sometimes too much news, right, too many rumors and stuff like that, and if you're bored with technical, you're already very familiar. If you're an advanced trader, you're already very familiar with your favorite tools like stochastics, RSI, Bollinger Bands, or moving average. Then it's time for you to explore something new and enjoy learning something new, especially during this MCO time. Okay, so I'll just give you a brief picture of the big picture of what I'm doing today. So I just not to teach you a FCPO strategy that can make you a lot of money. Rather, I just want to share alternative ways or dimensions to look at things so that trading can be fun and learning how to trade can be fun. And it's not just about graph and stuff like that. Okay, right. So the first thing I want to share about is the basic understanding of quantitative modeling. Okay, right. Quantitative model means that you want to create a model that have certain prediction value, that it can predict something or is able to measure something. So that's called a quantitative model. So to build a model, you need data, you need input. Okay, model is the output. You came up with a model, but to do this model, to create this model, you need input, and input is data. So most of the technical analysis tools like Bollinger Bands, stochastics, moving average, those tools are before 1990s. Yeah, like Bollinger Band is 1970, MACD is 1965, moving average is 1950, and also stochastics is 1970. So all these are pre-1990s tools. The main input is price. Okay, the main input is price. All right. But they are more than price when it comes to input. So there is a saying, I think everyone knows the saying, it's called GIGO. Okay, GIGO means garbage in, garbage out. So if you only have price, your model will be limited to a certain extent. Okay, but it means only the price of the asset that you trade. Okay, but if you have also the price of other assets that you do not trade, or you have something more than price, like for example, you can have volume as an input, you can have news as an input, you can have satellite images as an input. Okay, so there are some, because I was as a fund manager in Singapore for about a few years, so I do know some of the fund managers all around the world in Singapore, where there are crude oil fund managers who actually use satellite technology to actually keep track of all the container ships that move around the world, so they know exactly when the container ships are going to arrive at the port, how many ships actually sank in the sea, and the big data driven algorithm will tell them how this will impact on the crude oil price and can real-time calculate how the price will fluctuate based on real-time satellite tracking of all the crude oil ship containers ships. Okay, so that's actually something very, very interesting. All right, so this can be the input to a model, not necessarily just price and price alone. Okay, price is just one dimension. So I'm talking about different input dimensions will decide how multidimensional your model could be. Okay, but today I won't be talking about something so advanced. Okay, it's very interesting to explore, but I'll just be sharing with you the basic of quantitative modeling using a few prices rather than just one price. Okay, as a one dimension to build a model. So as you can see, this is the latest FCPO chart for the October contract, right? And it's down and then it's up. So of course, technical analysis is that it's a history, right? It's on the left side of the chart, but what you want to predict is the right side. So does this chart has any predictive value at all? Is always arguable. How predictive is this chart? How much can you predict out of this chart? But all we can see is this chart. So there is definitely more than that. Not more than just looking at the chart and drawing lines and support and resistance and trend line. There's definitely more than that. So I'm just going to share with you something that is entirely different from what you see in this chart today. Okay, so to do that, we need some data. Okay, so how to get data? Of course, the best is get from a paid source so that the data is reliable. Okay, so what are the paid sources? You can get from Bloomberg, you can get from Bursa station. That's the venues where you have reliable data, but they are not free. So if you want free data for static analysis, means that it's not real time, but you can build these models while you just have some historical data. You can also build a model. It's static, but it's okay. You can get from, let's say, investing.com. Yeah, you can get some FCPO data. All right, you can get it from there. You just go to the website, right, investing.com, or you can go to Yahoo Finance or Google Finance or whatever. There are many places where you can get free data of FCPO, right? And you can just go to historical, all right? Click the period that you want. Okay, there's one important part here is that if you want to create a good model, your input historical data shouldn't be too little. So quantitative analysis actually follows a lot of, okay, oh, some of my friends, sorry, just messaged me, well, asked me to kambate, keep it up because they are watching. That's interesting. Very nice of them. So as they say, we are social animals, we need each other's support. Okay, right. So some of the data is, yes?
Alex, allow me to interrupt you a
Yeah.
while. Can you close out some of the pop-up box as it come my side? We see some gray boxes that may block the present. Yeah, that would be good. Okay.
Okay, all right. It's blocking the
better.
presentation. Okay, sure.
Okay, yes.
Thanks.
Thank you.
Thank you. All right. Okay, good. Thanks for telling me because in Webex it does, in Zoom it does not. So I do not know that it blocked. Thanks for reminding me. So, okay, right. So, okay, so let's not block the screen. Okay, so this is one area where you can get historical data. Okay, FCPO, you can get it from investing.com. Okay, right, you can click here, download data. What I said just now is that the historical data need to be of a certain amount so that the quantitative models are reliable. If the data is less than statistics, okay, because quantitative modeling follows a lot of statistics. Okay, so statistic principle. So if the data is less than what is considered statistically non-significant sample size, okay, it varies. But let's just have a rule of thumb, a ballpark figure, is that it should not be less than at least, okay, 100 sample size data. Because I do know that sometimes some of you do not have a way to get free FCPO data of different months. Okay, so minimum at least is 100. The best is you can get between 300 to 500 data, historical data. That is good enough to build a good model. Okay, right. So here you can have put in your time range here from what date to what date is a day data. The time frame is daily, means every one row is 1 day's closing price. Okay, end of day closing price. At least have 100. The best is have about 500 data. Then you click download. You will be able to get the data downloaded, okay, to your computer. right? So from here, you are able to open it up. This data normally is in CSV file, okay? In Excel file, you can open it up using Excel, and that's what you see, okay? For example, I download and collect all the data of different months of FCPO. So it's August, September, October, November, December months, okay? And I collect all this data, and I can put all into one Excel, all right? So that's what you can do. Arrange the data nicely. That is actually the steps on what we call preparation, data preparation step, all right? Okay. So for more reliable data, I would say go to a paid data source like Bursa Station. You'll be able to have more accurate and reliable data. You won't have many missing data, because I did try to download from investing.com. I realized that they are missing data, and there's nothing you can do about it because it's free source, right? They are not obligated to give you very reliable data. So if you download from Bursa Station, the data will be a lot more reliable and they won't be missing data. So you go to this symbol called FCPO CC dash futures. It means that it's the continuous contract, so that you can get the historical data. Go to click historical price, okay? Highlight all the data there, okay? Inside the Bursa Station, the historical price, that's what you can do. And then you can paste them, paste as value, okay? Paste special, paste as value into an Excel. That's how you can get the data to Excel from Bursa Station, okay? So here you have open, high, low, close, volume, open interest. So if you want to arrange nicely like what I did just now, all you need is just to extract the closing value here, okay? And let's say this is a September contract, so you just change the word from close to September, and then you extract again, do the same thing for October, and then you change the close to October, and then you extract the same thing for November, and then you extract the same thing for December, and this is what you can get, something like this, okay? So it's extracting one file by one file and combining the closing price of all different calendar months together, and you put it nicely and arrange nicely. This is part of data preparation, okay? All right. So that's what you can do, okay? So next, in Excel already, are we going to analyze in Excel? Of course not, because Excel lacks statistical tools to analyze and to build model, okay? So definitely you can create indicators, okay, from these files, or you can build models, but not in Excel. So it has to be exported to somewhere, some other software, to build your model or to build your indicators. Like for example, you want to build a specialized indicator that is your own idea, that is not available in all the brokers' platform, okay? You want to have your own customized indicator, you can actually build it in MT4, okay? MetaTrader 4. All right, MT4 is a free platform that you can download from internet. A lot of people thought that MT4 has to do with Forex, which is not. It's because Forex brokers use MT4 as their platform. But MT4 is actually a free platform for retail traders that you can actually use the MT4 platform for free to program your own indicator. And the key question is, then how do you import this FCPO data into MT4? That's the step that a lot of people are not aware. Okay, so this is how you can do it. Okay, you can actually go to any of the MT4 you download from internet, right? Just run the MT4, the MetaTrader 4, and you just go to any of the symbol, because we are not going to use any symbol there. Just MT1 symbol, clean everything. And what you can do is that you can actually import the data from the Excel file just now that you downloaded. Yeah, remember this file that we download from Bursa Station or from investing.com, yeah? And then we arrange the file nicely, right? Like August, September, November, all this, okay? That's what we did. That is actually for modeling, okay? But what you need to do if you want to import into MT4 is that you don't have to do this step. What you need to do is that you must have the open, high, low, close, okay? And volume, right? You need this Excel, you can directly put into MT4, and you can populate the data after you clean that any symbol. You populate it with this Excel data, and then you can see FCPO price appearing, the chart appearing in MT4. And from here, you can actually create new indicators with this data, or you can apply your own customized indicator to back test, see whether the indicator works or not, okay, on FCPO data. That's how you can do it in MT4. Other than FCPO data, you can also import Malaysian stocks into MT4, or Malaysian or PLCI futures into it, and you can do back testing in MT4. Okay, so that's one very simple way which is free of charge. that you can actually do to create your own customized indicator. Okay, so if you want to import into MT4, what you need to do, I just repeat one more time, is you need to have this type of setup or structure. In Excel, date, open, high, low, close, volume. If you do not know the structure exactly, very simple. Just look at MT4's structure and you follow exactly the columns, and you'll be able to import successfully. You might have a few challenges in the beginning, but after a while, it should be okay. Right? Okay, so then you can, once the data is inside MT4, then you can do your customization of indicators in MT4. That's one free way of doing things. Okay, but that's not what we're going to talk today, is how to create a customized indicator, but rather we want to talk about how to build a quantitative model for FCPO. So that is what we are going to do, is we're going to do it in Matlab. Okay, there are a few softwares that can do this. One is Matlab, M-A-T-L-A-P. Okay, Matlab. Okay, Matlab is quite an expensive software. You can buy it online, or you can download the free trial version to actually use it. Or you can have a student version, which is much cheaper, right? And of course, we are Malaysian. I do know that there are some other places in Malaysia that sell Matlab cheaper, so I'm not going to name those places. You can go and find. But Matlab is one of the ways you can build a model using the data from Excel. Okay, other than Matlab, you can also use like IBM's SPSS. You can use eViews, okay, Stata, okay, and a few others. Okay. Right, Minitab and all those. These are all the statistics software that you can build quantitative models of FCPO on. Okay, so I'm just going to explain about Matlab and introduce you to Matlab today. All right, okay, so what you can do here in Matlab is that you can go to the import data in Matlab. Okay, you import the data from Excel, like just now you save as a XLS format, the Excel format, or you can save as the CSV format, right, the separate value format into Excel, and then you can import this Excel into Matlab. That's what you can do. You can just click here, import data. Okay, go and find the file. And this file, what is this file? This file is the one that I showed you earlier, the September, October, November, the arranged nicely already. Okay, every column is 1 month's data for different months' data for FCPO, and that is what the file is about. You find the spread data file, and then you go to import, output type, change to column vectors. From table, change to column vectors. Then you'll be able to extract each column separately as a variable. Okay, as a variable, and then click import selection. And what will happen is that the imported data will appear in the workspace of Matlab as data set. Okay, data set. So it become, every single column become a variable, become a data set. All right, so this spread data will appear here. Each month is a time series. Okay, it's a time series data set. All right, this is your raw data to build a model in Matlab. All right, so these are the steps. These are the steps. Okay. So that is step by step how to prepare the data and how to import, extract the data from somewhere. Okay, and how to put the data to the software. All right, like a Matlab software or SPSS software or eView software, or you can put into MT4 software. Okay, so these are the exact steps. So those of you who come to my class before, you know that I'm quite technical and details in describing how the things are being done. Okay, all right. Next question, next topic is, after you prepare the data well and you already import the data, next we want to explore what should we do with the data, right? After you put into a statistics software, what's next? That's actually the more important question to ask. Quantitative concepts. Okay, quantitative concepts. This is what I'm going to spend a majority of today's time on. Okay, I'm going to finish this talk at 9:30, and then we are going to open for discussion. Yeah, so I have another half an hour. So I would just want to focus on just one step so that I will not confuse everyone, because I'm just going to share one method today, which I think is useful. I've tested it with real account and it works. In my testing period, I'm not going to guarantee that it's going to work, because that is not into the future, because past result is no guarantee of future performance. But I'm just sharing with you new ideas. That's what today's topic is about, and let you explore interesting ways of doing FCPO trading. Okay, so the concept here is this is a simple concept. Okay, we are going to test if any 2 calendar months data have some form of relationship. Okay, right? And this is the test. the name of this test is called CADF. Okay. Sometimes when you find a lingo, like come across a lingo where it's very deep or you've never seen before, don't have to be afraid, because what you need to find out is what does this test do. Don't be intimidated by a very complex name. Like for example, CADF stands for Cointegration Augmented Dickey Fuller Test. So, oh, this is so difficult. I'm not going to learn it. You know, don't think that way, because those confusing or bombastic names are just statisticians of a way to, you know, make them think their things feel very cool. But what's important is, what does this thing do? Okay, you have to ask yourself. So what does this thing do is, it's going to measure relationship of 2 or more calendar months data. Okay, that's what it does. So I have an example here. If you put the August and September month, these two data, and we use this test to measure their relationship, what we are going to try to do is we are going to see, are these two September and August month data, are these two data, we call it Y and X, are these two data co-integrated? Okay, I'm going to show you some comics later. What does it mean by co-integration, so that you understand better. But this concept of co-integration is very important. Means that, does it exhibit mean reversion properties? Okay, because why? This is needed for this strategy to work. If this doesn't happen, the strategy is going to fail. That's the reason why sometimes spread trading does not make money. Sometimes spread trading, when the spread care too much, not necessarily spread trading will always win. Sometimes you lose as well. The reason is because sometimes the spread traders do not measure the co-integration properties before they enter a spread trade. That is actually one of the reasons why, not the only reason, but one of the reasons why. So it's very important, before you enter a spread contract, means you buy one month and sell the other month, you do a calendar spread. It's important to actually measure the co-integration value, which is the CADF test. Okay, what does this test do? Okay, let me just put into a more detail. What does this test do? Okay, this test, as you can see here, okay, let's ignore whether it's a spread or is it butterfly. As you can see here, let's look at the number first. Okay, the number here is very important, and the key is, the more negative the better. Okay, the more negative means that they are very, very well co-integrated. It means that they have a very strong relationship. It means they are going to mean revert. It means they're going to come back to each other. Imagine this as husband and wife. Okay, co-integration is a relationship like a husband and wife. Correlation, as most of you know, correlation is a relationship like a boyfriend girlfriend. All right, correlation can break off anytime, like girlfriend boyfriend can break off anytime, but husband and wife relationship is stronger. That is co-integration. Means that even though they are far apart, eventually they will come back to each other together. So imagine that way. That will be easier for you to understand this concept. Co-integration is like husband and wife relationship. Correlation is like boyfriend girlfriend, which is easier to break off. Okay, imagine that way. So the more negative, the stronger is the bonding between these two contracts. Okay, so here are three values here. You can see there's a 1%, there's a 5%, and there's a 10%. Okay, all right. 10% tells you that if the measured CADF value of these two calendar month, September month and August month, okay, let's say these 2 months, if it's let's say negative 4.3, and then the 10% critical value is negative 3, and negative 4.3 is more negative than negative 3. The more negative, the better. Yeah, remember this, right? If it's more negative than negative 3.089, that's the threshold point, means that there is 90% chance these two calendar month data or price are going to mean revert. They are going to come back to each other. That is how spread trading makes money. Yeah? And that is actually have 90% chance of happening. If this value is more negative than the 5%, negative 3.4, which very clearly this value is more negative than 3.4. Negative 4.36 is more negative than negative 3.4, correct? Yeah, that means that there is 95% chance that August and September month are going to mean revert to each other. So there's 95% chance of success of this strategy. If this CADF value is even more negative than the 1% critical value, which is negative 4.029, that means there's 99% chance these two price are going to mean revert. come back to each other, and there's 99% chance of success in that trade. Okay, so that is actually very, very important to take note of that. Okay, so that is the meaning of 90, 95, 99% of confident interval. All right, let's go back to our original August-September month example. You can see that the value here is negative 3.88668. Okay, that is for August-September month co-integration value. It means that there is at least 10% or 90% chance is going to mean revert. It is more than negative 3.4. That means that there is at least 95% chance it's going to mean revert, but it is less than negative 4.025. That means that it's not as high as 99%, just only up to 95% chance of mean revert, but not more than 99% chance. But it's actually good enough. If there's 95% chance of success, I think as traders, we would take the trade. Okay, that is for calendar spread. Okay, that's our spread. But here, the second example that I showed just now, all this value, right, is for a butterfly. Means the co-integration property of two spread, set odd spread versus odd set spread. Okay, these two spread or any other two calendar month spread combined together to form a butterfly spread. So some of you who are traders, who trade FCPO, you know what is a butterfly spread. So before you enter a butterfly spread of 4 legs, okay, measure this CADF. If the value is more than, normally is higher than the CFDF value for a spread, for a butterfly is normally higher, means that there's higher chance of mean reversion, means there's higher chance of making money. So those of you know that you maybe will make less, but it's a more reliable profit potential when you do a butterfly, right? So that is actually a higher chance. So this is a butterfly's CADF value, whereas this is a spread, two spread calendar spreads CADF value. Okay, so if I hope you understand that if you're a trader, this will hit as the main point that you are missing out in your strategy. If you're not a trader, this might sound too complicated to you. It's okay, right? But remember it, because next time when you reach a certain stage, you will realize that, oh, this is the key that I've been missing out. Okay, you will have that actually realization at a certain point of your journey. Okay, next, what is co-integration? What is CADF? I'm going to show you something more at more detail, so that that's why I told you the whole topic I'm just going to focus on one concept, because the strategy only need one concept to work, which is co-integration concept to work for this whole strategy. Okay, so to understand co-integration, you need to understand the concept of stationarity. What is stationary and non-stationary? Okay, let's open it up. This is the normal December month non-stationary normal price. Okay, price is a trendy, and you can see this is non-stationary. When it's non-stationary, you cannot use it for statistical analysis. It's useless. You need to make the data stationary first. Means you need to remove the unit roots. All these are very bombastic words you don't have to understand. You just need to know that you need to do something to the price data. If not, price itself is not useful. Okay, so you do certain things in eView. That's what you can do to prepare the data. Okay, so that you can do one level difference here. If you don't do it in eView, it's very simple. You can also do it in Excel. So what you need to do in Excel is that, maybe I'll show later, right? That you just have to use today's price minus yesterday's price divided by yesterday's price. So how many percent change? So you are talking about periodic return. That will achieve the same effect of this, what you do in eView, one level difference. You make the data stationary. So what you see is on the left-hand side is the original non-stationary December data. What you see on the right-hand side is already after you're doing the first level difference, or after you process the data becomes stationary. You can see it revert, okay, it mean revert around the central mean of 0, and this data is what is useful to build a model. The data on the left is not useful. The data on the right is useful to build a statistical model or quantitative model. Okay, so stationarity is very important. All right. Okay, the variance, okay, is the square value of standard deviation, which represent volatility, and they do not change over time. That is called stationarity. Okay, consider two prices, both non-stationary. Okay, right. These two prices is, let's say, for example, September month and August month, or October month and November month. These two are both non-stationary, their original price. But if you combine these two prices together using a certain equation, okay, they may actually become stationary and co-integrated. Okay, even though these two prices are not stationary, if you combine them together, and they might be co-integrated, even though two prices are not stationary. So that is the part. This is the concept that is hard to understand. So I'm going to use a comic so that you understand. Okay, let me show you this comic. Okay, consider a drunken man and his dog. Okay, the drunken man's walking steps are quite random, just like an FCPO price. They are random walk. And so are his dog's walking steps, also quite random. Two of their steps are quite random. Okay, so by right, both the drunken man and the dog's steps, the way they walk, are random. They are non-stationary. Okay, but as the dog stick close to his master through his hearing and smell, even though on its own the man walk in a random manner, the dog also seemingly walk in a random manner, but the distance between the drunken man and the dog is relatively constant. The distance do not deviate far away from each other, because why? The dog, through hearing and smell, stick close to its master, so it doesn't deviate too far away. Thus, we can say that even though the drunken man's walking is random, but the distance or the spread between the man and the dog is pretty stationary. We say that their walking paths are considered to be co-integrated. They are even though each one is walking randomly, they are non-stationary, but because they stick close to each other, they have a certain pattern of moving together. So we can say that their walking paths are considered to be co-integrated. And if that is the case, you can do a calendar spread strategy on that. Based on that, that is co-integration. Okay, so I'm not going to spend too much time into explaining the rocket science of co-integration. I have a few topics here. Okay, but okay, there's a lot of rocket science here, so I'm not going to explain. But I hope you understand the concept. The concept is two price data are not stationary, but if you combine them with an equation, they may actually have a stationary pattern, because the two non-stationary price stick to each other at a certain distance, and they move at a certain consistent pattern together. That is called stationarity. Okay, right. So if the FCPO data are stationary or non, is it co-integrated or non-co-integrated? Before we do this strategy, we have to test first if the calendar spread months data, if they have this property. If they are co-integrated, then we can do this strategy. If they are not, the strategy is not going to work. Okay, so how to measure it? You can use Johansson's co-integration test. Okay, that is actually what we did earlier in Matlab, but you can also do it in eView. The same thing, but you're doing it in eView in a different way. So you can see from here that it's proven using Johansson's co-integration test in eView that they are co-integrated, of at least two pairs are co-integrated. You can prove. That's why I say it's a science, quantitative, because every time you repeat the experiment, you come to the same conclusion. You can say that, oh, we are all looking at different things, interpreting different things from the same thing. We will all come to almost the same conclusion. That's why it's a science, it's not an art. Okay, so you can see that if the FCPO data have co-integration, okay, and the p-value, you can see the p-value here, is less than 0.05, then we can say that this is significant enough to reject the null hypothesis. There is co-integration between these two calendar months data. Then we can do this. Okay, so you can do the same thing in Matlab. Okay, run the code of co-integration, and this is what you get. Okay, whatever you see earlier that I tried to explain to you, step by step, this is how you derive at the result. Okay, of course, you might not be able to catch everything because I'm explaining too fast because of the lack of time, but do explore this method. There are a lot of resources online that you can just search. You just have to Google CADF method to find co-integration, or you can just have to search Matlab's software, how to do co-integration. You know, just Google some keywords like this, you'll be able to find step by step. Okay, so compare the result with the benchmark, and you can see how co-integrated they are. If they are co-integrated, then you can do this strategy. You can do this strategy. Okay, so from here, I'm just going to explain to you that there are different types of spread trading. Okay, there are commodity spread trading. Okay, intermarket means that you are actually selling one market and buying the other market. That's not what we are doing. This is called intermarket. Same month contract, different products like gold and silver, long gold, short silver. That's not what we are trying to do. This is called intermarket spread trading. That's not what we want to do. Another one is called inter-exchange spread. Means that, like for example, long the SGX SICOM rubber and short the Malaysia MCX rubber contract. So this is called inter-exchange. Same product, different exchange. That is also not what we are going to do today. It's called inter-exchange spread. So we have intermarket spread we have inter-exchange spread, and then this is intra-market spread. That's what we are going to do today. Intra-market spread is example, calendar spread is a type of intra-market spread. Means that same product, different calendar months. Okay, different calendar months. Like for example, June month is the blue color, September month is the brown color. Okay, they are not exactly the same. Okay, they are definitely, they might not even be correlated, but they have some form of co-integration possible. And so if all these tests that I mentioned earlier prove that these two has a long-term relationship of co-integration, means they are like husband and wife, then you can actually apply this spread strategy to them. Okay, so you can see they might not be correlated, but they can be co-integrated. Okay, so that's how you can look at the months in your platform, like TC Pro platform, right? KLCI, FKLI, or FCPO, the June month and the July month. That's how you can look at the spread contract. Okay, near month is August, far month is, for example, December. So near month is always in front, far month is behind. Okay, so these are all the some of the screenshots I got from Excel Learn. I print screen. Yeah, that's how you can actually go and find these YouTubes to understand the basic of spread trading is all by Excel Learn in YouTube. You can go and find them. Okay, so I'm not going to go into the basic. I'm just going to share with you this strategy, this particular strategy. When you plot these two together using a formula, what you get is a residue. Okay, we call it the spread analysis. August, December spread analysis, for example, these 2 months. It can be any 2 months. Okay, so give an example, these 2 months. The residue is after you plot the best fitting line, the distance between all the outliers with the central line, that's called the residue. Okay, so load the residue spread code in Matlab, run the code, this is what you get. What you get is actually 2 calendar months. All right, you will get something like look like this. It's called the residue plot. Okay, residue plot, okay, is where you can find opportunities to trade. Like for example, when it hit the 80% confidence interval of negative 0.5, you can see that is the item number 13, data number 13, data number 48, and data number 81 here. 3 opportunity there where it hit below 80% confidence interval. Okay, that is where what you can do with it, you can actually long the near month and short the far month. Like for example, long August, short September, or long October, short November. You understand my idea? When it reached below here, the threshold, it crossed the threshold, that's where you can long the near month, short the far month. And then on the other way, if it goes up there and past the threshold on the upper side, like past the 0.5 and above, like there are 3 opportunities here, the data number 11, data number 31, and data number 42. You can see here, right, that if they were up here, that's where you can short the near month and long the far month. Like for example, short August, long September, or short November, long December. Okay, remember, yeah, so if it's up there, short the near month. If it's down there, long the near month. You just remember it that way. Okay, that's how you can use this type of strategy. Is called the residue spread strategy. Okay, the opportunities total, you can find about 5 opportunities here where you have at least 2 ticks of profit, at least 2 to 5 ticks of profit with 95% chance of success. If it's 95%, and if it's 80% confident interval, means they are around 80% chance of success. Okay, so FCPO, okay, September, October month, okay, you can see just now was August, September month, right? You have 5 opportunity, and if you see September or October month, you can see 4 opportunities here, okay, where you can get more than 4 or 5 ticks profit. All right, and you just have to try to look at different months, different 2 months, look for their CADF value, and if it's good, then just do the month's spread. And the timing of entry is where for example, when you see that the data number 26 hit below here, right? The next day when the market open, enter the spread and hold for 1 day. Sometimes you only need to hold for 1 day. The max is hold for 3 days. You'll be able to get your 2 to 5 ticks. With that 95% chance of success. That is the concept and the principle behind. Okay, so other than just the spread, you can also do the butterfly offset month versus set odd month. Okay, which has about negative 4.36. So if seems co-integrated, so this is the butterfly spread. Okay, whenever you see the below here is where you can long the near month spread and short the far month spread. And then if it's up there, you can short the near month spread and long the 5-month spread. Okay, if this is too confusing for you, does not matter. Okay, just go to Excel Learn and understand what is spread trading. Then you will get the basic. Okay, right. So with all this testing, okay, right, how is the result? The next question is how is the result? With all these opportunities, hold for 1 day every time this happens, enter the next day when it open, hold for 1 day, okay, and then maximum you can hold is 2 to 4 days, but you can see that if you hold for 1 day, the winning percentage is much higher if you were to hold more than 3 days, okay. If you hold for 1 day, the winning percentage is about 87%. So the testing with real money is that 70 trades over 6 months, average you have about 12 trades per month, doing different calendar months combination, you can win around 61 trades over 70 trades. Net profit is about 632 ticks, average about 0.0105 ticks per month. That is a result in the experiment that I did earlier. As I told you, I am not an FCPO specialist. I don't trade FCPO every day. I just conduct FCPO experiment every now and then just to see whether my strategy also works on FCPO. I'm mainly an index trader, which I do this machine learning trading on Nasdaq Index and S&P and KLCI. Okay, that's my main, but I do some experiment on FCPO once in a while. Okay, right. Can this be done for Malaysian stock? The answer is yes, in theory. Like for example, you measure the CADF on, let's say Maxis versus DG stock. Okay, at this certain points, DG is overbought, Maxis is oversold. That's where you should short. Okay, short DG and long Maxis, and at these certain points up here, Maxis is overbought and DG is oversold. That's where you should short Maxis and long DG. Of course, only banks with PDT, proprietary day trading, can actually do short of the stocks. Normal retail cannot, but in theory, it works for stocks as well. But of course, because of the rules of Bursa rules that you cannot short stocks, so retail are not able to do it. The bank PDT department will be able to do this and earn on this. Okay, so that works on stocks as well, not just only on FCPO or FKLI. Okay, right. And one very interesting thing is that don't just limit yourself to FCPO different calendar month spread. Also explore intermarket data analysis. Okay, it can be working like I explained earlier, right? Not just intra-market, but also intermarket spread trading. This is more on intermarket, and you should be able to see that certain things are co-integrated to FCPO, like soy oil, soya meal, and soya bean futures. Okay, so do explore and see that who is leading who. Okay, not only spread trading, outright trading, you can also use this as a leading indicator, like for example, soya bean futures or soya bean meal futures or soya bean oil futures as a leading indicator that leads FCPO. So this is one test that I can share with you that can tell you who is leading who. This is called Granger causality test. Granger causality test, yeah, in the using eView. So if in the Granger causality test, if the probability is less than 0.05, means this thing is leading FCPO. So for example, you see here, the probability is less than 0.05. Soya bean does not Granger cause FCPO. It means that soya bean price is leading FCPO. And here, soy meal does not Granger cause FCPO. The number probability p-value is more than 0.05, means that soy meal futures does not lead FCPO. And here, soy oil does lead FCPO. So you can find two leading indicators here already, which is soybean futures and soy oil futures. So you can look at these two to trade FCPO, which is being led by it. So not only for spread trading, you can do intermarket analysis and one lead the other for outright trading of FCPO as well, seeing how the others are performing and then trade the lagging. Look at the leading, trade the lagging is outright trading strategy other than spread trading. Okay, and of course you can do a modeling on that using Gutsch model or ARIMA models as well. So this is a Gutsch model. You can see from here, from the model, that it is very significant. Okay, the probability that tells you that the volatility of FCPO can be partially modeled by the volatility of soybean and soybean oil futures. The impact on FCPO volatility is significant. This is besides the topic today, which is spread trading, but I want to show you that don't just think about FCPO alone and the price at different calendar month. Think out of the box and look at intermarket data that can even double confirm and different dimension to actually lead FCPO. So I want you to open your mind and look at other data outside, maybe even Dalian data of yellow beans or all these soybean data which leads FCPO. Okay, it's very important to open your mind out. Of course, last of all, other than this this strategy, I think I came to the end of sharing with you a spread, so-called the residue spread strategy. Last thing is to automation. This part actually I share in the previous topic already. That's not what today's topic is about. Yeah. So I'll just briefly go through that you can actually automate this whole strategy using the local broker like RHB. I'm not going to recommend any broker, but I'm just sharing with you. Some brokers allow automation. Okay, they allow automation. You can do it in RHB, Yukata. Okay, you can do it with let's say Affin and some other brokers. Okay, so you just have to, you can, let's say if you're doing RHB, you can use quick screen trading. Okay, of course, I'm not recommending one broker. Different brokers have their own API vendor. You just have to ask them how to automate this whole process. But automation was the last topic, not this topic. So I'll just tell you, these are the step-by-step how you can automate. Yeah, so in the end, this whole spread trading strategy can be automated using this way, using automation method. Okay, right. So as I say, okay, you can also not just automate it, and it's not just spread trading. You can also use machine learning, okay, algorithm on FCPO as well. Again, it's not today's topic. It's something extra for you to explore, because why? Today's purpose is to open your mind to explore new ways of trading FCPO. So not only you can manual trade, you can automate trading. Not only you can do outright trading, you can do spread trading. You can do intra spread, inter-market spread, inter-exchange spread, and you can also use machine learning, okay, like this to predict FCPO. Okay, like for example here, there's this machine learning is telling you that the there's a what is the probability of short. The red color is only going down is 22%, going sideways is 28%, and going up is 48%. All right, so that tells you that there is a chance of going up. Okay, so the case study here is that if the machine learning tells you there's a very high chance to go up, then the system can automate and actually long FKLI or FCPO or something like that. Okay, that is not today's topic. I'm exploring, telling you that, well, some other topics I might explore with you, machine learning models. Okay, right. So does it really work? Okay, let's look at the machine learning volatility model using Gutsch and Arima. Right, you can see that it actually tells you where to short and where to long. You can short here, long here, short here, long here, short here. That is part of quantitative modeling, okay, using Gutsch and Arima. So long, when the LSTM classification model reach a skew bias to short, the system will short. If you reach a strong bias to long, the system will long. So you can see here, the red color is very big value. When it reach 40, skew to 40, the system will actually make a short. FCPO, okay, the system, the LSTM system make a short here, and you actually take profit here, and that was a real trade that I did to experiment and tell you to prove that actually machine learning model can be applied to FCPO as well. So that was the trade done quite recently. Just to there was a few, like 2 weeks ago, I think 1 or 2 weeks ago, I performed this trade to prove that actually LSTM model, which is the AlphaGo model they used to beat the chess master, can be used to predict and to do FCPO outright trading as well, not just spread. Okay, so today I go slightly beyond spread, but I don't want to go too far. Today's topic is mainly on how to do spread trading. Okay, so I think that it's already 9:30. I will end my topic today. I will leave some of the information for the next topics, let's say about machine learning, about AI and stuff like that. Okay, so today we focus only on spread trading, especially on residue spread trading using a quantitative model. Okay, so let's end with that. All right, and I'll pass the time back to the administrator, and we will continue with the Q&A session. Okay, let me pass back to you. Thank you very much.